Here's a graphic depiction of how the New Markets Tax Credit Program works. In the middle is a Community Development Entity, or the CDE, that once it becomes certified is eligible to apply to the federal government for a direct allocation of tax credits. Once an award is received by the CDE, it therefore identifies borrowers that have a gap in financing with high impact projects in low income communities that could utilize the benefit of the subsidy provided by the New Markets Tax Credits. Terms are agreed to between the CDE and the borrower, and at that point the CDE goes out to identify an investor in the tax credits. That investor essentially pays the net present value for a stream of tax credits over a 7-year period that we'll talk about a little bit later in this presentation. But suffice to say that the investor puts money in that is able to be very flexibly invested because the investor receives all of its return in the form of the tax credits. So there is no return of principal, meaning that the CDE can be very, very flexible in the terms, in terms of debt service coverage ratio and loan to value. And at the end of the 7-year compliance period, the loan is typically forgiven so that the borrower has a true cash equity when all is said and done.